1.9 billion euros. That's how much cash Germany's hottest tech company claimed it had parked in two bank accounts in the Philippines. In June 2020, auditors finally asked the banks directly. The accounts weren't real. 7 days later, Wirecard, a 24 billion euro company sitting in the DAX, the index of Germany's corporate elite, was bankrupt. Not from a crash. Not from a scandal someone uncovered overnight. From a question that took 10 years to get asked. Before this is over, you're going to see a financial regulator respond to fraud warnings by banning bets against the company and filing criminal complaints against the journalists who reported them. You're going to meet a chief operating officer who vanished on a private jet the day after the news broke, and who investigators say is now living in Moscow under a fake name, working with Russian intelligence. And you're going to see the one piece of paper that would have stopped all of it. It costs almost nothing to send. Nobody sent it for a decade. One thing to keep straight as we go, Marcus Braun, Wirecard's former CEO, denies everything. His criminal trial in Munich has been running for over 3 years, and there's still no verdict. So his role is what prosecutors allege. The 1.9 billion euros, though? Wirecard itself admitted the money, in its own words, in all probability does not exist. Let's clear the table first. Wirecard wasn't hacked. The market didn't turn on them. There was no rogue trader, no pandemic shock, no one catastrophic deal. The thing that killed Wirecard was built into its accounts for years, hiding in the one place nobody wanted to look, and the people whose entire job was to look kept finding reasons not to. To understand how that's possible, you need to see what Wirecard actually was. Wirecard started in 1999 outside Munich, processing payments for the customers banks wouldn't touch, porn sites, and online gambling. Marcus Braun took over as CEO in 2002, put his own money in, and started telling a much bigger story. Germany had watched Silicon Valley print trillion-dollar companies while its own economy ran on car parts and chemicals. Braun, black turtleneck, glasses, talking about digital payments and artificial intelligence, looked like the answer. The press called him Germany's Steve Jobs, and the country wanted to believe it. The numbers said believe it. By 2006, Wirecard was in the tech DAX. By September 2018, it entered the DAX itself, knocking out Commerzbank, a 148-year-old institution and once Germany's second biggest bank. At the peak, Wirecard was worth around 24 billion euros. For a moment, this payments processor from a Munich suburb was worth more than Deutsche Bank. In April 2019, SoftBank put in 900 million euros. The growth charts only went one direction. There was just one problem with those numbers. A lot of them weren't numbers at all. They were a story with decimals. Here's what Wirecard really did. In Europe, it ran a genuine payments business, real merchants, real transactions. It also barely made money, because payment processing is a commodity. You're fighting for fractions of a cent on every transaction. The spectacular growth lived somewhere else. In markets where Wirecard had no licenses, across Asia and the Middle East, it claimed the business ran through 3 partner companies, Alalam in Dubai, PayEasy in Manila, and Sinjo in Singapore. The partners supposedly processed the payments, and Wirecard supposedly collected a fat commission. On paper, this third-party acquiring business produced about half of Wirecard's revenue, and nearly all of its profit. Now the part that should make you sit up. The profits from this business didn't flow to Wirecard's own bank accounts in Germany. They piled up in escrow accounts in the Philippines, supposedly for regulatory reasons, managed by a trustee in Manila. By the end, those accounts were said to hold 1.9 billion euros, roughly a quarter of Wirecard's entire balance sheet. So how do you audit money like that? You send the bank a confirmation request, and the bank tells you what's in the account. It's one of the oldest, most basic checks in accounting. For years, the most important number on Wirecard's books was instead vouched for by paperwork routed through the trustee. The documents flowed through the very structure the audit was supposed to verify. Half the company's profit, confirmed by the people holding the pen. That's not a machine that makes money. That's a machine that prints paper saying money exists. The difference only matters if someone checks. So, did anyone check? People tried. That's the maddening part of this story. The Financial Times started publishing inconsistencies in Wirecard's accounts back in 2015. Reporter Dan McCrum would chase this company for 5 years. Short sellers published fraud allegations in 2016. In January 2019, a whistleblower inside Wirecard's own Singapore office, its own legal counsel, handed the FT evidence of forged contracts, and Singapore police raided the office. And here's where it stops being a story about one company. Germany's financial regulator, BaFin, looked at the fraud reporting and went after the reporters. In February 2019, it banned short selling of Wirecard stock for 2 months, the first ban of its kind for a single German stock. Then it filed criminal complaints against the FT journalists. Think about what that did. The referee didn't just miss the foul. The referee tackled the people pointing at it. For investors, it read as an official all clear. The German state stands behind this company. The pressure kept building anyway. In October 2019, the FT published internal spreadsheets suggesting those partner profits were fabricated, and Wirecard had to hire KPMG for a special audit. KPMG spent 6 months asking for basic evidence. In April 2020, it published its conclusion, in careful auditor language. It could not verify that the third-party profits from 2016 to 2018 existed at all. Could not verify the cash either. 2 months later, EY, Wirecard's regular auditor, which had signed off on these accounts for about a decade, finally had to do the thing it had skipped, confirm the escrow money directly with the banks. June 18, 2020. EY refuses to sign the annual accounts. Wirecard announces 1.9 billion euros is missing. The 2 Philippine banks say the confirmation documents are forgeries. They've never seen the money. The stock drops 62% in 1 day, from 104 euros to 39. June 19th, Brown resigns. His number 2, Chief Operating Officer Jan Marsalek, the man who ran the Asia business at the heart of it all, is suspended. That night, he boards a private jet from an airfield outside Vienna and flies to Minsk. He's never faced a courtroom. Investigators say he's in Moscow today, living under a false identity, working with Russian intelligence. That is, allegedly, where the chief operating officer of a DAX company is right now. June 22nd. Wirecard admits the 1.9 billion euros, in all probability, does not exist. Brown is arrested. The Philippine Central Bank confirms the money never entered the country's banking system at all. June 25th, 2020. 7 days after EY's refusal, Wirecard files for insolvency, the first DAX company ever to do it. The stock is on its way to under 2 euros, down 99%. SoftBank's 900 million is gone. The banks are out around 3.1 billion. And more than 20 billion euros of shareholder value has simply evaporated, much of it belonging to ordinary Germans who'd bought the national tech champion. So what actually killed Wirecard? It's tempting to say fraud, and prosecutors say that's what it was. They allege the executives had been faking the accounts since 2015. One Dubai-based executive has already confessed in court. But fraud is the crime. It's not the system failure. The system failure is that this fraud needed 10 years of nobody performing one basic check, and it got them. Walk up the chain. Investors didn't verify the cash. They trusted the regulator. The regulator didn't verify it. It trusted the audits and spent its energy investigating the critics. The auditor didn't verify it with the banks. It accepted confirmations that came through a trustee in Manila. Every single layer outsourced the same question: does the money actually exist? To the layer below it. At the bottom of the chain, there was no vault. There was a letter, and the letter was forged. Compare that to FTX. FTX hid real customer money behind a line of code. Wirecard hid the absence of money behind a piece of paper. Same fatal flaw, opposite directions. One unverified control that everyone assumed somebody else had checked. If you build anything, a company, a portfolio, an audit, a database, there's a Wirecard question hiding in it. Which number have you never verified at the source? Not the dashboards built on it. Not the reports that summarize it. The thing itself. Wirecard is what happens when everyone in the chain answers, someone else handles that. The money was never hidden. It was never there. For 10 years, nobody asked the bank. Wirecard faked money that never existed. Greensill did something even stranger. It lent billions against invoices that hadn't been written yet. Real loans, built on imaginary paperwork, and it took just 7 days to come apart. That story is already on the channel. The link is on screen.